Welcome back, folks, guys and gals. This is Greg Silverman, longtime Chief Investment Officer, and bringing you another session of Come Learn with Me. We do a number of different features. Come Learn with Me, looking over the management. And I'm going to introduce something a little bit new here as well, and that is just before we read each article, I just want to take a look at the technical patterns for that thematic, if you will. So the next first article we're dealing with is gold and silver, gold royalties. We'll read that in a second, but I wanted to take a look and get a sense of where the GDX, the VanEck Gold Miners ETF was sitting. So first of all, let me just say this is not a recommendation. This is just purely for educational purposes, and I just like to get a sense of where we are in time and space. So my analysis may not be worth all that much, and it's certainly not a recommendation, so do your own due diligence. But on the gold miners, one thing we notice is that if they hit a low, that would be in the COVID low, right, about March of 2020, and with the subsequent high, quite a bit higher actually, so it moved from a high of, let's see, a low of about $15 to a high of what's that, $40. So at least a doubling and more. And it's been in corrective mode since probably, I think that's August of 2020. We've really been in this corrective mode. So here again, just drawing. I'm not this huge technical guru. I just like trend lines. I think if the trend is your friend, so if the trend is up, stick with it. If it's down, stick with it. So this would be the uptrend as far as I could tell, going back to that low in March 2020, and we're still above that uptrend. And then the downtrend, which would have been the correction from August going all the way down, that seems to have been broken roundabout of, what have we got there? That's February of this year as we climbed higher, and we're now correcting back down. So I'm not sure if that trend line is going to hold, but if it does, that will portend well for gold. Gold miners, gold mining stocks. Okay, let's get into the article. Again, we rate articles that everyone likes that we shared from last week, and we'll read them through together. And if you want to know more about our actual investment programs, take a look at the links down below. A lot of good information there for you. So, right. Evaluating gold royalty companies to gain exposure to precious metals. Adding precious metal exposure to your portfolio, gold royalty company considerations. Investors have many options to gain exposures to gold. They may purchase gold bullion, gold coins, and gold exchange traded funds. And that was what we just looked at. And mutual funds, gold mining companies, or gold futures and options, publicly traded gold producers and royalty companies may offer an attractive way to invest given the disproportionate percentage impact higher commodity prices have on a company's bottom line and valuation for a given percentage increase in the commodity itself. While most investors are likely familiar with mining companies and how they operate, royal companies may be less familiar. All right. What is a gold royalty? So think of this as a yield play, right? A gold royalty is a contract that gives the owner the right to a percentage of gold production or revenue. Since royalties typically cover the life of a mine, gold royalty companies benefit from the exploration upside that may extend the life of a mine and thus increase the amount of gold or revenue they receive from the mining company at no additional cost. Several ways to generate royalties. First, royalty businesses may help finance a development project in exchange for a royalty. Second, a royalty business may purchase existing royalties from third parties. And third, and three, a royalty company may take a property that they already own, sell it to a mining company, and retain a royalty on the property. There are several types of royalties. The two most common are NSR and NPI royalty. The net smelter return royalty is an agreement where the mining company agrees to pay the royalty owner a percentage of the revenue, less refining and smelting costs. A net profit interest royalty entitles the royalty owner to a percentage of the profit from a mine. So I think essentially one is based on revenue, one is based on profits. A stream is a purchase agreement that provides the owner of the stream in exchange for an upfront payment, the right to purchase all or a portion of one or more metals produced from a mine at a negotiated price for the life of the agreement. The negotiated price is generally at a significant discount to the spot price. Royalty company advantages. Compared with investing in gold production companies, royalty businesses generally benefit from low overhead costs, geographically diversified asset portfolios, and exposure to multiple operators. Additionally, they avoid costly exploration expense which is borne by operators while sharing the benefits and upside of exploration investment in properties where they retain a royalty interest. Like mining companies, royalty businesses offer great leverage to change in gold prices than investing in bullion. Lastly, royalty businesses generally seek to build portfolios of producing royalties that support dividend payments to shareholders. Investors in gold royalty companies understand that revenues increase with rising gold prices, increasing production on its royalty properties, and a growing royalty portfolio, while costs remain relatively fixed and stable. These various scenarios position royalty companies to thrive in good markets and weather more challenging sets of circumstances. As a royalty company grows, it offers the potential for multiple expansion, dividend payments, and the ability to execute larger transactions, which could accelerate its growth. Junior royalty companies generally perform well in their early years since they can grow rapidly based on an increasing capacity to transact larger deals. Additionally, junior royalty companies may become attractive acquisition candidates for a larger royalty company seeking to enlarge its royalty portfolio. Investor considerations. It's important for investors to keep several factors in mind when conducting due diligence on prospective royalty company investments. These include management, asset portfolio, asset quality, jurisdiction, and valuation. Management. Should you bet on the horse or the jockey? It's important to evaluate management's history and track record of creating value for shareholders. Does the management team reflect a balance of technical, financial, legal, and capital market expertise? Is the board of directors comprised mostly of independent directors who provide a diversity of relevant experience and perspectives? Do they articulate clear objectives, and is their business model sound? Most importantly, do they focus on areas that they know and employ a disciplined growth strategy, or are they seeking growth at any price? Asset portfolio. How is the company's asset portfolio balanced between royalties that are producing cash flow streams versus royalties that are expected to produce cash flow within 5 years and or longer? Asset quality. Because royalty companies have little control over the decisions of the mining companies that control the properties on which the royalty interest is held, it is important for investors to evaluate the operators associated with the properties in the royalty portfolio. Are they well-capitalized major mining companies or small startups? Additionally, it is helpful to evaluate mineral resource estimates associated with properties in the portfolio and the operator's plan for development. Jurisdiction. While geographic diversity is a selling point for most royalty companies, it is often helpful to consult the Fraser Institute's annual survey of mining companies to check if royalty interests are in favorable mining jurisdictions versus high-risk areas. Valuation. Royalty companies are often valued based on price to net asset value. Net asset value is the net present value or discounted cash flow of all future flow of a mining asset, less any debt plus cash. Price to net asset value is the company's market cap divided by the net present value of all mining assets minus debt. For those that pay a dividend, investors may also compare dividend growth rates and yield. Larger companies generally trade at higher valuation multiples, which generally increase with scale due to lower perceived risk, due to greater asset diversification, and a proven track record of growth. As royalty companies grow, they may be able to establish and grow dividends to shareholders, offer greater liquidity due to listing on major exchanges, and benefit from broader research. Some may also benefit from their inclusion in stock indices. For those that pay a dividend, it is important to know whether the dividend is paid from operating cash flow or whether the company is borrowing to pay a dividend. Takeaway. Just as with other classes of equities, mining royalty company investing has categories and nuances within those categories that separate one from the other. Investors should be mindful of each of these and find respected sources of information on the particular name they are considering. Channel check can be a gold mine, excuse the pun, of information when searching for companies, understanding their business, and looking at their numbers. Okay, there you have it, folks. Royalty companies, a good way to get a dividend yield out of gold mining and other mining operations. I hope you enjoyed that. Hope you learned something. Take a look at our links below and join us again. Subscribe and like. Greg Silverman out for now.